Hey everybody, this is Alan Parker with Cahoon Care Associates, and I thought today would be a valuable tool for those in the industry out there. I brought in my resident expert on payroll, and we're going to just talk a little bit about paying caregivers under the table and sort of the pitfalls that come along with that, the challenges to help make clients aware of what they're taking on when they do that. I mean, in some cases, people certainly do that, but there are certainly some things to be aware of. And Kevin knows this more than anyone else, so I just thought I'd bring him in. Kevin Moore from Paychex. Thanks for joining me again.
Thanks for having me, Alan.
So let's get down to brass tacks here, and let's talk to what's the difference between paying someone under the table and paying someone, not the right way, but I guess in my mind, I always think of it's the right way.
The right way, yeah. there's always I always say going legit, right? That's the easiest way to describe it to people. It doesn't sound so, criminal. So, I mean, I think, first of all, it's important to clarify probably the difference between the two, like you said. So, when you're paying a caregiver cash, what we're talking about is the income is typically not reported. You're not withholding taxes. You probably don't have, the insurance coverage that you're required. And the opposite side of that is the legit way is you have the caregiver on a payroll service. You're withholding taxes, and then you have the appropriate insurance policies in place to cover you in case anything ever comes up.
Workers' comp, things like that.
Exactly. I think the other thing, in this situation, like a lot of people, I say a lot of people, but some people, when they have a loved one that they're hiring somebody to care for, they may not own their own business. They may have never owned their own business. But in this situation, they have a caregiver, they are the employer, and the caregiver is their employee. So when we're talking about employer, we're talking about the person paying the caregiver here, because that's what they are.
Yep. No. And I think a lot of people don't understand that, or they think, oh, well, they're not going to worry about me. Chances are I'm not going to get caught. Risk reward. And, I think today, when we go over it, they might start to think twice about that, because there are, as you've told me, it's a lot more common that people get caught. And it's not just the people who are employing, but also just the employee, the people who are the caregivers. Most times they in their mind, they're like, oh, I'm just going to get paid under the table and I'll get more money and this, that, and the other thing. But there are some things that happen when this happens that they aren't immediately aware of, that it's not to their benefit.
Right.
So let's what would you say is one of the first risks that comes foremost to your mind when you think about someone who begins to pay things under the table?
Sure. And preface it by saying there's a lot more than what we're going to talk about here, probably. Depending on how much detail you want to get into, there's a lot of rights and wrongs and why you should and why you shouldn't. But the first one that comes to mind for me is a lawsuit. It's kind of the more basic one. I think people kind of in the back of their mind know it's a risk. First off, the person paying the caregiver, when you have a household employee is what we call it in the payroll industry. So a household employee, you don't think about liability and being sued. So like a regular small business, somebody might be incorporated or an LLC. It typically almost never works like that when you are paying a caregiver. So the caregiver gets out of their car in the wintertime, we're in New England, and slips and breaks their hip or injures themselves or gets sick on the job. They can sue you for medical bills. You can end up having to pay for it out of pocket to avoid a lawsuit. Those are the two big ones, right? And then the other side of the coin, so that's paying somebody cash, right? Because you don't have record and you don't have the right insurance coverage.
You don't have any proof that you did anything, right?
It's like it never happened. And then so then the other side of that, right? The legit way, you have payroll, and when you have payroll set up, you have workers' comp, and workers' comp is designed for these situations. And workers' comp is designed to cover lost wages, and also medical expenses. So it takes the pressure off of you and your employee. They may not want to sue you, but if you don't have workers' comp and they can't afford to pay it themselves, they're going to kind of have their hand forced.
Right.
So that's the first one that comes to mind, because it's much more common than you'd think.
And then we kind of go into Uncle Sam and taxes. They always say there's only a few things that are certain in life: death and taxes, right?
Yeah.
And you know that the IRS, they're going to come after their money. So paying someone under the table. Well, I'll let you tell all our listeners out there why this is maybe not a good idea.
Yeah. Okay. So these two words put together are some of the scariest that most people will ever hear, and it's tax evasion. And it sounds extreme and it sounds aggressive, but the reality is, it's what it is.
Right.
The employee, by not paying payroll taxes and not reporting the income as income, paying the appropriate taxes to the state and to the IRS and the unemployment offices, they're committing tax evasion. And you, as the employer, you have your responsibilities as far as the taxes, like your matched, FICA and unemployment and federal unemployment. And, if you're paying them cash, you're getting out of paying those too. So you're actually also committing tax evasion as well. I know it's a scary phrase and it sounds a little ridiculous, but I mean, it's what it is, and it's a lot easier to get caught for it than you might think.
So talk to me. Most people are like, oh, that's never going to happen. So give us a scenario where this is something realistic that could happen.
Okay. So by far and away, the easiest thing that can happen, and there's no malice, no ill will or bad intent when it happens. Say your loved one gets better, or passes away, or something happens that you no longer need the services of your caregiver. Okay, and you part ways. Well, your caregiver now finds themselves unemployed and not bringing in the income that they were. And a lot of people would not think twice about, I'm unemployed, so I'm going to file for unemployment. Even if they don't think of it, somebody in their life is probably going to go, oh, well, just file for unemployment. And the reality is that as soon as they file that, the DUA, the unemployment office, they're going to open a case, they're going to investigate it, and they're going to find that you have no record of being a registered employer in the state. And it's automatically going to trigger a state audit. They're gonna audit you to see how much an unpaid unemployment that you owe. They're also probably going to flip it over to the Department of Revenue and say, hey, you might want to take a look at these guys. And then not only that, but a small portion, when you pay state unemployment taxes, gets paid to the federal government. It's called FUTA, federal unemployment. And that small percentage gets put into a federal pool that is used for unemployment when a state runs out of funds. So it automatically triggers an IRS audit as well. So dominoes.
There
1,
you
2,
go.
3. Yep.
And it's not, isn't there like it's not a short period of time too, right? So like you can file unemployment, and then, maybe that they had even took another job, right? And so it could be innocuously, like someone goes, hey, what's the last 2 companies that you worked for? And then your name comes up.
So, I mean, and they may not file unemployment. They may realize they can't file unemployment when they first part ways with you as their employer, but they could go work, for another company, a W-2 job for however long, and then totally not realize that as they're filling out the application, then they ask for your last 2 employers or your last, last 6 months of employment, and they put your name down. It's an automatic trigger is what it is. It's, for the state, they have quotas. They're trying to bring in revenue. They're looking to catch people. And for them, it's like shooting fish in a barrel. And once they catch you, they flip it over to their buddies over at the Department of Revenue because they're in the same situation, right? They're going to give it to them. The IRS gets involved, and then you're on their radar. And after that, they're going to keep an eye on you because they don't want to see you. They don't want to see you make this mistake again.
Well, and no one wants an audit because then they'll go back and they'll look at everything that you've done, right?
They can just open the books if they want. They can go back as far as they want and look at everything. I mean, they don't need reasonable cause to audit you. It can be random.
So even if they don't file unemployment, what are other situations that might come up where this can be revealed?
Yeah, so this is where it probably gets a little stickier. A situation comes up, and your caregiver files a dispute with the Department of Labor or with the state. Now, this could be over, hours worked, unpaid overtime, not paying out agreed upon sick time or vacation time. And honestly, whether the dispute is valid or not is completely irrelevant because it's going to automatically trigger an investigation. So, they're going to look into it. And they're going to want to go through your employment records. And it's going to do 2 things. It's going to, first of all, your employee is going to automatically win their dispute, right? Because as Alan knows,
why is that?
Well, I'm pretty sure you have an idea, but in the state of Massachusetts anyway, the burden of proof always falls on the employer. We're a very employee-friendly state. So an employee makes a claim, they don't have to prove that it happened. The employer has to provide records and prove that it didn't happen. And if they can't, the employee's claim goes through. It's validated. So that's the first thing. And the second thing, trigger an audit.
Oh,
We're going to write down that line of dominoes again.
So yeah, that doesn't seem like it's that seems like a big risk to me.
Yeah, and what it really is, right? Is what's the best way to say it? It's a silver bullet in the gun of the employee, and if anything ever comes up, they hold all the power because they're the ones who have the power to trigger this. They don't even have to have a reason. They can file a dispute with the Department of Labor of the state for anything. As soon as they drop a dime, the state's going to look into it. They have to. And you're going to have no records. They're going to come to your door and ask for a list of items, and you're going to have maybe cash slips from the ATM. I don't know. It won't work. I can tell you that.
Yeah, no, and it's true. And these things might, like the scenario that you used where, your parent has died and you didn't pay them, through a series where it's all recorded, then it's your word against their word. And, if they get in a situation, the caregiver has you over a barrel.
Yeah, and they can file a claim up to 2 years after you sever the employment. So
that's not a short amount of time.
They might be fine when you leave, and then something in their life could happen. Someone in their life could say, hey, I know these rules a little bit. Why don't you try this? I mean, there's all different kinds of scenarios that come up. And none of them are good for the person paying the caregiver. None of them.
And it's just, it's just a way to protect yourself, right? I mean, if you keep it above board, then you have the records and you can protect, yourself as someone who's employing.
Exactly.
But this isn't even all the reasons. But there's also stuff for the employee, right? I mean, the employee, if they're paid under the table, then they have no record, so they can't have basically they're gonna have a hard time getting a credit card or a car loan or a mortgage or anything like that. So
they basically don't exist.
Right.
As far as the IRS is concerned. Yeah, mortgage, car, credit card, car loan, all those things are in the immediate, right now. But they're also not paying into Social Security, right? And they're not paying into their Medicare. So if they ever do want to stop working one day, that they're not going to have, they're not going to have paid in anything into that to get any benefit from it.
Right.
And we talked about unemployment a little bit. I mean, you see what's going on in the world right now. Crazy things happen. And if they're not paying into unemployment, or the employer is not paying in on their behalf, then you don't exist. I mean, you're not eligible for any of the relief programs that are coming around right now. And you're kind of going to have to figure it out on your own. And it's hard to make an excuse or a case, otherwise.
Right. And so what are other, are there any other, ones that come to mind that you can think of that are?
For sure. A big one is Medicaid.
Okay.
So basically, as you know, Medicaid is designed to, they pay for medical treatment after personal assets and personal funds have been spent.
Right.
So over the years, like any crafty person does, they start to figure out little loopholes and ways to get around that. So while the person is still living, they start transferring assets or gifting, their inheritance or cars and homes and things like that to their loved ones, so that they can qualify for Medicaid earlier. And they also don't lose their assets, as they're going, as they're becoming ill.
Yep.
So that starts happening. So to combat that, Medicaid enacted a 5-year look back period. So now what they do when you apply is they go back 5 years, and they look at your assets, and they basically take any transfers of assets in those 5 years, any gifts, cash gifts or otherwise, and they're subject to penalties because they're assuming that you are trying to pull one over on them and save your assets and still get the benefit of Medicaid.
Okay.
Yeah, and so that's a big one. Now where this comes into play is when you go to apply for Medicaid, they're going to want your records. And if you're paying a caregiver cash, where does cash come from? It still comes from the bank. So along with everything else that they're going to be looking for. So as they're going through those records, if you're taking out $1,000 a week, out of an account,
Yeah.
in cash, and it's just a withdrawal, the Medicaid's going to come in and look at that and say, well, show us your records. What is this for? You can tell them all day till you're blue in the face that it was to pay a caregiver, but without, payroll records and quarterly returns and W-2s and earnings records, like, in receipts from tax deposits and payments made, like anybody could say that. So now all of a sudden, all that money you paid to a caregiver is subject to those penalties as well. So that's a big one.
And then they might even get in touch with the IRS and say, hey, this person hasn't paid taxes.
Yeah, I'm pretty sure they're all under the same roof at some point. So yeah, I would say that's probably a very good possibility.
So it's not all doom and gloom, though, right? There are some actual benefits for paying someone above board, right?
Yeah, I mean, yes, of course. Like even above and beyond, the peace of mind. Which for me, if I was paying a caregiver, people have a lot of stress in their life. You have a sick loved one. Like, do you really want to be going to bed and waking up every morning hoping that everything goes well? What you're saving is minimal compared to the risk that you're taking. So peace of mind is huge. Just for me personally, that would be the biggest thing.
Sure.
But you go talk to a CPA or an accountant. There are tax deductions for this. Like there's the dependent care tax credit. So when you pay for care for a loved one, there's a box on your tax return for you to write it off and to get that tax credit. So yeah, it's not all doom and gloom. They want to encourage you to do the right thing. So they do put some some good things into place to encourage you to go legit.
A little bit of a carrot with a lot of a stick.
Exactly. You know, you gotta give the carrot too. You can't just do the stick.
Well, Kevin, thank you so much. I know for me, and I know I've had this conversation with a lot of different people, and I know a lot of people will appreciate, having this conversation and learning some things to help. So thanks again for stopping by. And again, Kevin Moore from Paychex, and give him a call if you have any questions. I will post his your phone number. Why don't you just let everyone know your phone number?
Sure. So my phone number is my direct line, 508-369-5889. Call with questions, anything that you're inquiring about, I'll do my best to provide as much information as possible.
Great. Thanks, Kevin. And everyone else, have a great day and pass this along.
Thanks, Alan.